By now you should all have, for those of you who are following my homework I gave you last week, and also for those who are new, I don't expect you to keep up or follow a single thing I'm saying. Think of it as a 3-month loop, and so the lesson that you missed last week you'll get in 3 months' time, and it'll back onto this one and it'll all click in and make sense. So everyone just joins at different parts of the loop. Okay, so last week you were to make a random indicator system. So what I wanted you to do was to look through and find an indicator you had never seen before, had no idea what it was, and build a system with it. Who did that? Okay, who tried to but found it really hard? John wasn't happy with what he found. I looked at 2. One was pretty good, and one blew my socks off. I was very impressed with it. Alright, well I'll show you what I found. At least I want you to attempt the homework, because then you'll learn the lesson. Okay, so each week I share with you a noise type system, a market move type system, or a monkey system. This week it's a market move system. I wasn't sure if it was a market move system, but I decided, look, it is on hourly, and it does work over the long term. So I am going to say it's a market move system. It's on GBP USD, sells only, TSI, 3 and 14, bouncing off 0 and coming fresh from -50. I'll show you an example of that, with almost an equal profit and stop, 49 profit, 50 stop. Running at 88% success over the last year, giving you a signal about once every 3 weeks. So I was quite happy with that. I've made a comment here, it's only a year of backtesting. Systems like this really should work since 2007 before using them. And it's better to build your own rather than use mine where possible, as you have emotional responsibility for it and you own your work, so to speak. And if I forget, your homework for next week is to build a system on Bollinger Bands. But I'll probably go into that a little more, but if I forget, that's what I want you to do. Okay, so here's what I did. I looked through the list at ones I haven't heard of. TSI, I had never heard of it. And then GBP USD, I do not trade that very much, and for a particular reason. But I thought, look, I'm going to try and you will see that reason, but I'm going to try and build it. So I've got an indicator I've never heard of on a market I really don't trade much and don't particularly like, and that's where we're going to go. What I did is I read the TSI description, so I had an understanding of what it was. So I'll show you the TSI, where you get the description from, and then we'll come back to this. So I brought up my indicator box like this and clicked on TSI. Had no idea what it was, so I read the label. And the label told me TSI is True Strength Index. It is a momentum-based indicator developed by William, designed to determine both trend and overbought oversold conditions. The TSI is applicable to intraday timeframes as well as long-term trading. I thought, alright, well that sounds about right. So I applied it. Now the first thing I thought is, that looks suspiciously like CCI. So I applied CCI as well. So on the top here is in green is TSI, and the bottom is CCI. So immediately I was able to go, it goes in that box, so to speak. Remember I said if you look at enough indicators, you'll pretty soon be able to put them into about 4 different boxes. You'll have about 20 or 30 indicators in each box, but they generally come back to about the same. And this is an example of TSI coming back to my oscillator box, and very similar to my CCI. We can see up through here it acts quite a bit different, but yeah, generally rising, falling around the same. Now, also if you were making a comparison like that, obviously you'd want them both set at the same period, wouldn't you? You'd want them looking at the same amount of candles. So CCI set at 14, and the TSI was set at 14 as well. So if they were set at completely different amounts of candles, then yeah, it'd be harder to make such a comparison. Okay, so I looked at that, made that comparison, thought, alright, now I know kind of what I'm dealing with. I decided I liked the TSI as it was, and so I left it on the standard settings. So my next option, of course, was to change the fast and the slow, and I adjusted them a bit, but I decided, look, whatever their default settings is firstly what everyone else is going to look at, so it's going to be the most common, and also it's probably going to be the most recommended by the developer, as is. And then the next thing was, I thought, well, here I am with a market that I don't enjoy and rarely trade, and an indicator I've never heard of, so I'm going to at least allow myself to put it on hourly to have a fighting chance. And part of your homework last week was to see if you can aim for the profit target arriving on a particular telltale part of the market. So remember, we had candles like this with massive tails on them and all the other candles like that. And if you had gone long sort of down here somewhere and your profit target arrived on one of these huge tails and then the market dropped back down, then I said, what that's telling you is you're doing something very right. You're in sync with how the market's moving, because there's a convolution, I think if I've got that word right, where everything's falling together at that particular point. And your trading plan is concluding where many other trading plans of different varieties and styles are concluding as well. So we were putting the horse before the cart. We weren't going to just look at the indicator and then see how that worked with price. We were first putting on a price itself first, and then saying, okay, with my new and wacky indicator I've never heard of, how does it react with this solid market move that I'm after? Okay, does everyone remember that? Yep. Okay, well, I'll show you how I went with it. And I pulled some interesting lessons out of it too. So what I went for is I said, okay, it needs to be coming up close to, well, I put a zero line right the way through, so this is the zero level on TSI. I have no idea what zero represents, but anyway. And I said if it comes up from below and turns over and points down, then I'm going to go short with that. But I had a little condition with it, which was that price needs to also have come from a low level, because I noticed that it turns over below the zero quite a bit, but that doesn't necessarily mean much. But if it has come down from quite low, then it is significant. So I said it first needs to have been sort of below this 50 level here, and then if it comes up and stays below the zero and then turns just under it like that, between 0 and -6 to be technically spot on in through this area, then I'm interested in going short, and away down it goes. Now you'll notice that this short, by the way, is landing on a small wick, so I was happy with what I found. Now here's another one. Note the wick again, please. Now I would say maybe 20% of my signals actually arrive on the wick like I was talking about. So I'm not blowing my trumpet and saying I got them all. I didn't. But it was a good beginning point and something to aim for. And if I was to ever achieve a trading plan where many of the signals arrive at those areas, then I'd be very pleased with myself. So here the profit target arrived at this wick here, and you can see there's quite a bit of wick going through there, and then the market shifted and turned up, so I was happy that I'd got it. I'm sort of tuning into a solid move there. And the zero line is in through there, I guess you could say. And the turn is actually this turn here. And the turn has come from below the 50, so it's come from down in these levels, moved up without going above the zero, and then rolled on over. So can everyone see what I was after for my shorts? Coming from right down low, coming up, but not crossing the zero. It has to still be below the zero and be between 0 and -6, and then just roll over like that little one did there, which if you drop it all the way down you can see that. And so then I was wanting to roll on down, catch my move, and then I'm very happy with my move. So there we are. Now that's my profit line for the last, we're in the 10th month now, year and 2 months, and it's kind of in the direction I want. I've had a stop out there, and I had a stop out there, but overall pretty solid, and it's giving me a signal every 3 weeks. So, okay, something to think about. So who thinks that's worth a clap? Not bad for a market I haven't seen before and an indicator I've never seen before. And can you see how, thank you, you can see how I went about it. Having looked at so many indicators, and I really make the generalization that they do fall into about 4 overall categories, I was pretty easily be able to throw that into one of the category of many I've seen before. So it's like, well, this is nothing new. And then with it, I was able to use it in a pretty familiar way. And away we go. Now you'll notice there wasn't a lot of rules with it as well. If I had taken that and I had got no end of rules, you're essentially strangling the signal. It's called shaping, and the signal will start working very quickly. Okay, but no, that was not done. The only rule really was that it came down from those low levels of below -50 up just near the 0 and then rolled on over. The next thing is the stats, and I want you to get quite excited about the stats and the whole thing, because then I'm going to make you a little more unexcited, but then I want to teach you a really key lesson. Maximum stop outs in a row is 1. 88% success. We had 16 wins and 2 losses, and it's for the last 14 months, so it's ticking along quite nicely. Can't complain with that. But now there's some key lessons I want you to learn from that. And this is where the learning begins. That's all nice, but this is where the learning begins. I showed you the last 14 months, but now I'm going to show you the last 2.5 years. So what you saw was from there forwards, and back through here is how it went before that. Now it's not a bad thing, because you can look at that and you can say, well, how the markets were back in the start of 2007 is pretty different to now. I mean, we've had a lot happen since the start of 2007. Another thing I look at when I look at my own performance through the previous period here is it wasn't going good or bad, it was really just sideways. It was just ambling along. There was hardly even a trade. I mean, I think through 2008 there might have been, just a very small handful of trades, and also through 2007 relative to what there was since. So I wouldn't say it went badly and then went well. It just wasn't happening at all, and then suddenly kicked in and started going really well. But you can see if I go from the start of 2007 to now, so the last more than 2 and 3/4 years, I'm running at 66% success. That includes all of that. So yeah, and maximum stop outs in a row 3. So still not bad. Remember, this is shorts only. Now this is where things get really interesting. And by the end of this, I hope you really enjoy the lesson. How did the longs go? One thing that I really enjoy is some of these trading systems out there where, people, they'll invent a product and it's one trading system and you buy it and it's long and short and that's because it's balanced and all that. It's like, yeah, okay, but consider the buys. Now, have a look at the longs. There's a lot to learn from this. So these are the longs through that period. From the same period through would be about there and forward. So this is if you did the exact opposite. So you wanted price to be in the positive above 50, come down, bounce just above 0, and you went long with a 50 pip profit, 50 pip stop, or thereabouts. And it's a miserable idea. In fact, you'd do well every time you saw that to do the opposite of what you should. So for shorts, go shorts, and if a long opportunity comes along, go short as well, and you actually double your opportunities, and your profit line would be twice the size. And you'd be very pleased with that. In fact, we've only had 1, 2, 3 stop outs through there as well. So the statistics would be as good as before and twice as profitable. So your stats would be twice as good as that, and you'd have twice as many trading opportunities. So let's just discuss what we're talking about for long. Does everyone understand what the opposite would be for long? So let's say the TSI was up here, above 50, came down, didn't touch the 0, but just curved on up like that to give us a buy. And then we would go long to benefit from a rising market. Well, what we saw is for the last 14 months, that doesn't get us anywhere. In fact, see, with trading, you don't care about the logic of it. You care if it consistently works. Right? You might look at that and you might say, why did all your shorts work and all your longs work miserably? I don't know. But I do know that the longs working miserably consistently work miserably, which means I've got an opportunity to short the shorts and I've got an opportunity to go short on the longs or to benefit from a falling market when a long opportunity occurs. Why? What's the logic behind that? Again, I'll tell you. I don't know, but I do know that it is consistently that way. Right? And all I'm looking for is to trade something that's consistently happening with the markets. Okay, so that's what's going on there. But isn't it interesting to see? You can see we had this rising profit line with just the shorts, and we look, oh, that's brilliant. I'd like to add the longs to that. Now, if you added the longs to that, then you'd look a little bit blue. Now, in conventional thinking, you'd say, no, I want it to be balanced. I want to have longs and shorts, because otherwise when things change, my whole plan will fall apart. Well, I say have longs and shorts. Absolutely. Have them on different FX pairs, though. Or where you can have longs and shorts on the same FX pair if the strategy is appropriate for that. But look at this even more. First of all, just make sure everyone's keeping up with me. Are you all keeping up with that and you understand that so far and find that interesting? Good. Okay, now for a really big lesson about just how efficient the markets are. Here's what I want you to notice next. Let's begin. You need to appreciate that the markets have the best human invention or example of efficiency in the world. They have the best ability to represent true value of price and represent basically zero in value, because as you know, you can trade, make a bit of money, and then trade some more and give it all back. Now, what you'll often see when you're building a trading plan, if you don't know how to build an edge because you haven't done our training, is you'll find that your trading plan will often become average and come back to zero. But have a look at this. This is fascinating. With this trading plan, see this bit here, how it was a solid up, right? If you added that together with this solid down, you'd have zero. So if you built this trading plan and you didn't know entirely what you were doing, and you said with conventional generalizations and just that you've just swallowed hook, line and sinker, so you're like, oh, it's balanced, it's long and short, and it doesn't work. The longs and the shorts would zero out, and your trading plan would be useless for the last year and a half. You'd look at that and you'd think that's not worth trading. But look at this more. Look at this. Well, we'll go back up again. Look at this. Look at this. This period through here for these 2 years was mildly down. Right? Now have a look at what was going on before that. It was mildly up. And that'd probably just about zero out as well. And you'll see that a lot. Okay, so the difference is we've looked at this, we've got a bit smarter about it, and we understand generally where this FX currency pair as a whole is going. Okay, so we're able to work with that and say shorts only. And if we wanted to, and I sometimes do this, I would say, right, every time there's a long opportunity, because I know how it performs, I'm going to short it as well, and my profit line goes up to about there and starts about there. Okay, there's another lesson to learn from all this. Remember, another key reason why people grow and shrink their account but don't actually get anywhere is they never know when their trading account is over. And we teach very clearly ways to measure when the trading approach is dead in the water. One is historical maximum stop outs in a row. So that's the first one, and we all understand that. Let's go remind ourselves what the maximum stop outs in a row for this one was. Right, for our shorts, that was our profit line. And the maximum stop outs in a row for the last 14 months is 1. So if we have 2 stop outs in a row in the future, then the relationship between us and our trading plan is over, and we're brave enough to walk away. Now, if I apply something like this, will it stop working in the future? Yes. Will it stop working next month? Well, perhaps, but I think I've got the best chance of growing my account next month with it. Okay, and that's the best you can do as a trader. And then you layer it and you have lots of best chances, so more than just one trading plan. Okay, the next thing, what's the next way we know when a trading plan is over? Is we observe that a larger and larger stop is required and a less and less size profit is required to capture successfully the same market move. So you'll notice I had about a 50 and 50 profit and stop. I might start seeing to keep that profit line growing in that nice rising manner that it was, I'm starting to need a 40 pip profit, 60 pip stop, then a 30 pip profit, 70 pip stop, just because I want to keep that line growing and I want each opportunity to be a success. But I notice with each previous opportunity that it's starting to edge closer before it goes where I expected. So when I see something like that and my profit target is smaller than my stop, then it's like, hey, no, sorry, it's over. Time to ditch this plan and get a new one. Okay, now the third one is maybe you didn't get, and this is new to those of you who have been with us for a while. I haven't discussed this before because I haven't had an opportunity to show it to you. Is you might only have one stop out in a row, like we have through 2007. But look at this. From 2007 to 2008, have a look at how our system went. We went up, down, up, down, up, down, up, down. Okay, now at 1 year later, we hadn't made any money, we hadn't lost any money. So you could have built your trading plan down over here in about mid-2006 and enjoyed it. It might have kept on rising through 2007, and that's nice. Let's just pretend that there was only one stop out here, not two, or maybe through that period for the profit line you built through 2006, you allowed 2 stop outs in a row. Okay, and you keep trading it. Now it hasn't. You're happy with it. It hasn't exceeded your maximum stop outs in a row. It hasn't. The profits and stop haven't need to be changed in a negative way. Perhaps you could change them in a positive way, and that's good for you. But you haven't had to do that. But a third thing is, maybe for a year it's just not going anywhere. So here is an opportunity to say, look, in a normal year, it goes at that angle. This year, it went that angle. So there's a warning before you hit with something like that. So you've got 12 months to figure that with this trading plan, if it was built in 2006, you had 12 months to think, maybe something's up, right, before the sky fell, so to speak. Would I really wait a whole year? No, of course not. Wouldn't you think something was up after at least 6? Absolutely. Well, I've got, as I said, I've got 17 trading plans. I built another one today. I've now got 18. I don't have room to keep track of them all, and I certainly don't want to be running one that's average. So even through here, if it just got a little bit average in that bit, then I'd be wanting to give it a can. But there we are. So there's now 3 ways to know when the use by date is hit and the food is off. What I wanted to show you though is, now it just gets more interesting. There's just so much to learn from this. On the left here, when it was working well, not only was it working well, but it was, guess what? It was arriving at a profit target, and quite a lot too, on these massive wicks. Can you see that massive wick there, where the profit target arrived and then dropped the market away? Excellent. So when it was working, it was a top-notch little thing. This is on the longs, remember? And have a look at this. This is another example. Now, any trading plan you build, if you can build one that arrives like that, okay, then you know that you're building your trading plan with the big money and the collective effect of the small and medium successful money, where their plans are arriving at the same point. And that's really nice. Now, I don't aim for this every time, but if I spot it, right, it's a real warm feeling. It's like, brilliant. Okay, so I don't want to put too much emphasis on it, but it's really nice to see. And I wanted to show you this one because it's quite interesting. here's a long, and price kept moving up. So it wasn't a candle with a big wick and then price dropped away. But that big wick was a telltale sign that, yeah, okay, price kept moving on up and good on it. But there was a lot of traders that, for their particular patterns and reasons why, all came to a point where they were getting out and you were with them at that point because of this big wick showing you that. So very cool. So, the random indicator lesson is, and hopefully you all built systems with a random indicator this week, is that the indicator is such a small part compared to the overall market bias. What this shows us is it doesn't matter what we do, we can't do much wrong on the short side, as we saw there. And it became more evident when we looked at the longs. But what this also shows us when we study these other periods is this currency pair in its entirety did a slow shift. Didn't happen quickly. It was a very slow shift in its overall direction, and it affected the underlying system. Okay. Now I wanted to make another interesting point about this. First of all, does everyone understand that? Does everyone find that really interesting, really insightful? That's not something you'd normally, unless it's modeled like that, just wouldn't occur to you in that clarity. I wanted to make another point to you here, which is notice also that you can tell a friend about this lesson, but telling them is not going to improve their trading results because they didn't do the homework. The learning's in the doing. So if I say to my old mate down the road, listen, it's nice that you're building trading plans, but the general direction of the market as a whole is so important, even though you're getting in and out on half an hour, or daily. And they'll nod and they'll go, yeah, oh, absolutely. It's in all the trading books I've read. And so that, yeah, they totally understand and away they go. But then you have a look at their trading and they're not designing their trading plans like I've shown you can with this one. Remember, it was all shorts. We don't touch the longs on this one. And if we did want to touch the longs for my given TSI trading plan, you're best to short the longs as well. Well, my buddy I just told down the road, he understood it all, but he's not going to apply an iota of it because he hasn't actually got his hands dirty in the doing, rolled up his sleeves and all. Okay, so I say there's two levels of knowing it, and I want you to be really careful with this, guys, because a lot of you have a fantastic general knowledge with the markets. Okay, but knowing it is useless. There's two levels of knowing, but few traders really know at the second level like you do today doing those exercises. So please always keep hands on and challenge everything that is general knowledge so you take it to that second level of knowledge. I'll give you another example of exactly what I'm talking about. I just mentioned that all indicators can generally come down to perhaps 4 different types if you want to break it down that way. Everyone listening to me nods and agrees. Yep, that's true, Greg. Alright, well when this week just been and you were looking at for indicators that you'd never seen before, who actually looked at a random indicator and went, I wonder if that's an oscillator, if that's a trend based, if that's momentum based. No, you looked at it and you thought, oh, I've never seen that before, that's nothing like I've seen. So you all had this first level of knowledge, but very few, I'm sure, owned it at a second level in a practical sense. So there's my trading offering for today from me. GBP USD hourly, 50 and 50, using the TSI indicator and with a favour towards the shorts. And as I say, I would prefer people build systems that are based on 2.5 years. This is really only based on 14 months of testing. Okay, I've got a question to leave you with. My question before was, okay, if USD Japan has a short bias, what type of bias does Euro GBP have? That was the question I left you with. I want everyone to answer that, please. What's interesting too, and this is really, if you zoom out on daily and you look at the last 15 years and you see the things been lifting or dropping, guess what? It's fascinating, but that does not always mean that that's the direction of the bias. When you actually start backtesting and writing systems, you'll find that the longs or the shorts, perhaps the longs are consistently working really well and the shorts aren't, but zoomed out on a view of the last 15 years, it may look the other way. but on hourly you might find it's quite different. Now someone says it depends on the time frame. Yeah, sure it does. If you're looking at half an hour or 15 minutes, it may not even bother you. A new question for you for this week, which is if Euro GBP overall has a long bias from the context of hourly charts anyway, what type of bias does AUD USD have? Most of you should probably pick that off the bat. Some of you might need the week to figure it out. John's question is, do you have lots of different systems simulating most of the time so you know when any one system starts working again? What I do is with a system that I may have had working well, and then it's just started to show signs of becoming average, then what I'll do is I'll probably every 2 months, I'll just have a look at it once every 2 months to see has life come back into it again. And very rarely do I ever see that. It is what, more often than not, it's what I would say as zeroed. So if you have a trading plan that's become average and you review it 2 months and 4 months down the track to see if it's come good again, more often than not it's remember how I showed you when it's all said and done it comes pretty close to zero if you don't know how to find an edge with it. It'll do that. Occasionally I can think of 2 examples. One, yes, the life came back into it just as much as before and it was very impressive. Another example, and this is more the case, John, this is more interesting. When you build a trading plan that's sort of good, but not good enough to trade, it was just kind of average, check those things every 2 months or every month. Because often I've written a trading plan that was pretty good, reviewed it in a month or two thinking, I've got a bit of spare time, I wonder how that carried on, because I was thinking of using it, but it just wasn't quite good enough. And lo and behold, I wish I had, because it became brilliant. And when I review it 1 or 2 months down the track, it is a really stunning system. So I think, well, great, now I can use it. Bob's asked me the question, do I usually use the 50-50 profit stop when testing? Well, I do begin with just a 50-50 or a slightly bigger. I might start, like one system I wrote today, I started with a 90 pip profit, 80 pip stop. And here's an interesting thing. When you're building your trading plan, guys, it doesn't hurt to start with the size of the profit and stop you want first. Because if you start, it's like, let's say you want 90 and 80, 90 pip profit, 80 pip stop. If you start that way, then the system you'll find, because you're particularly wanting to find a system that works, will end up being about 90 and 80. But if you start by trying to find a system that's 80 and 80, so it's exactly 50-50, and then you try and see, I wonder what would happen if I just made it 90 and 80, almost every time you'll find that it's worse off. So there's certain things that you don't have right from the start, but one thing you do have right from the start is you start with the profit and stop you want in mind. Now, what I do is I actually, because I more want my system to be a big success, is I start around equal, okay, because it's a lot easier than any other ratio to find one that's about equal. What I want to do though is I just want to make a point, and maybe if we ever meet up in person one time with you all in one way or another, I don't know, we might have a big party on the Sunshine Coast one day, but I'll illustrate this mathematically to you. Actually, I'll stay here. Just ignore everything on the left here. Let's say we're looking at this system and we manually found it. You didn't have this high-tech stuff I've got. You just put it together and you're quite happy with it. And what are we? I'll just call it 50 and 50. And you think, aha, I am clever. I must have a bigger profit than stop. Therefore, I will be more profitable. I have wonderful money management. I have read all my trading books. I am very wise. Alright, well, good for you. So let's say you make it 80 and 50. Okay, and sometimes I do this. It's amazing, and you can only appreciate it when you've seen it so much. But what you'll find is this is what your profit line will do. It'll go up 80 and then up 80 again and up 80 again and up 80 again. That's great. But then, see, let's say here we had 3 stop outs. Well, then it might do, say, 4 or 5 stop outs of 50, like that. And then it'll go up 80 and up 80 and up 80 again, and that's really nice. And guess where it'll finish? It'll finish at exactly about the same. This one's 3.4%. And I was doing this today. You saw in the free session that system I built that, see, this is at 3.4%. That system I just showed the profit line of was, I think, about 50%. I mean, it was a really big system. And there was 100 and I think about 123 trades or 117 trades in the system. So an awful lot of trades. It was over 2.5 years, a really big system. All sorts of things have happened in that time. We've had every type of market dynamic. And it had a 90 pip profit, 80 pip stop. Now, whenever I tried a small profit, like let's say I went a 40 profit, so I'm almost always guaranteed to get that 80 stop. Well, the line was quite jagged, but it generally, well, truth be told, it rose a bit less actually. And then if I made my profit even just, 20 pips more, so I made it 110 pip profit, 80 pip stop, it still only came to about the same level, but I just got more jagged. I had more stop outs in a row, and more jagged means more emotion when you're trading, and I don't like that. I'm after something smooth. I just want to grow consistently so I feel good about my trading. And you might say, well, why is that? Well, why it is because the market, you've found a pattern, right? You've found a pattern that obviously quite a few others have, because you placing a trade does not move the market. You're not big enough to. So you're riding on the back or on a particular market move of larger money, collective money, and bigger money. And so congratulations, you've found that and you're riding on that, and that's what trading is. All right. Well, those swings and those moves averaged out have a certain amount of inefficiency that the market is willing to give. Now, however you do want to design your profit and stop, it's really just going to come back down to about that. Now, I'm sorry to dismantle everything you've ever heard about profits and stops and your money management with that, but there's an exercise. If you please say yes, if you want me to do it, I can do it next week. But I actually manually write a trading system with OTG shorthand. I forget what the system is based on. And we've got a big collection of about 30 profits and stops and all the different signals, and so it's the whole system. You can see a breakdown of every single trade that makes it up, and we say, right, let's look at an equal size profit and stop, double size profit and stop, half size profit and stop. Let's look at waiting till it goes against us before we get in. Let's look at scaling out in multiple parts. We look at every different type of variety you can. And what's amazing is the market in that particular inefficiency has a certain amount that it's willing to give, and that's the bottom line. Okay, I've got a question. Who found that interesting, understands it now, and that really sort of clears things up when designing your profit and stop? Again, that's not something anyone can articulate to you, because most haven't really seen those variations and fluctuations and are able to sum it up in its simplicity. Okay. The reason I am is because I'm able to just change the profit and stop slightly, and in 10 seconds see my profit line change again, see my profit line change. And so I'm able to see how it affects all those trades every 10 seconds, and after a while you're like, and when you see it with all your different trading plans, you're like, wow, isn't that interesting? Now, so the question is, so should we all just have equal size profit and stop? No, absolutely not. One trading plan I've got, which I tweeted out recently, we had 140 pip profit, and I think the stop was a third the size. So our profit target was 3 times the size of our stop. We do have that. So how do we know when we should do that? Well, when you're looking at the trading move, it might be a type of trading move. It might be off the gap. You'll remember we did that quite some time ago, where it's just a small bounce, but when that particular bounce happens, the market move is monumental. And maybe there aren't a lot of trading opportunities with it, but when it happens, it just drops away. Or, in that situation as well, it flatly doesn't work. So there's no point having a generous stop equal to the profit, because if it's not going to work, it's flatly not going to work, so you may as well come and bring the stop in quite tight. If it's not going to work, you're out in an instant, but you do know most of the time when it does work, it just drops away entirely. and you say, oh, well, I'm just going to look for those types, and why doesn't all traders look for that type of signal? Well, that type of signal isn't around every day. It might be around once a month. And as you can see, the market balances that out too, because you can see if you trade more often, well, then you've got to go for almost an equal size profit and stop if you want a trading plan that gives you loads of signals. But if you want to be very patient, then you'll get not so many, but you can have a whopping profit for those monumental moves and a small stop if you know what you're looking for. But can you see how those two traders sitting in different camps at the end of the month would probably have about the same type of pips? Why? Because there's a certain amount of inefficiency that the market wants to give. Anyway, we're getting deep into theory. I hope I'm not losing some of you. But for some of you too, you are nearing the end of your coaching, so I did want to share it and see how you found it.